Welcome to another episode of Financial Market Insights for Traders. I'm your host, Sophia. Today, we're diving into a topic that's often misunderstood, yet crucial for anyone stepping into the world of trading: leverage.
It's a tool that can amplify your gains, but if misused, it can just as easily magnify your losses. So, let's explore what leverage is, how it works, and how to use it responsibly.
Leverage, in the context of trading, refers to the use of borrowed funds to increase one's trading position beyond what would be available from their cash balance alone. For instance, if your broker offers 50:1 leverage, you can control a position worth $50,000 with just $1,000 of your own money. This means that even small market movements can lead to significant gains or losses. Consider this. With 50:1 leverage, a 1% favorable move in the market could double your initial investment. However, the flip side is equally potent. A 1% adverse move could wipe out your entire position. This is why understanding and managing leverage is vital. Many new traders are drawn to leverage because of the potential for quick profits. But without proper risk management, leverage can be a fast track to significant losses. Let's take the example of Jake, a novice crypto trader. He started with $2,000 and, using 25x leverage, turned it into $6,000 in just 3 weeks. Buoyed by his early success, Jake became overconfident. He stopped using stop-loss orders and began taking larger positions. Then, an overnight market correction erased all his gains and left his account in the red. Jake's story is a cautionary tale about the dangers of over-leveraging without a solid risk management plan. So, how can you use leverage without falling into the same trap? First, if you're a beginner, it's advisable to avoid leverage altogether until you've developed a consistent trading strategy. Start with a demo account or trade at a 1-to-1 ratio to focus on learning rather than earning. Think of leverage like a high-performance sports car. It's powerful, but without the skills to handle it, you're likely to crash. Next, always use a position sizing calculator. This tool helps you determine the exact number of units you should trade to keep your risk consistent. For example, if you have a $5,000 account and want to risk 1% per trade with a 50 pip stop loss, your risk is $50. If 1 pip equals $1, you can trade one mini lot. This approach ensures you control risk before entering a trade, not after you've already incurred losses. Setting a stop-loss order is another critical component of risk management. A stop-loss automatically closes your trade at a predetermined level to cap your losses. You can set it based on technical analysis, such as placing it below a recent swing low for a long position, or using indicators like the average true range, ATR, to account for market volatility. The key is consistency. Don't widen your stop just because the market moves against you. That can turn a small loss into a significant one. When you do decide to use leverage, keep it small. Many professional traders use leverage ratios between 2-to-1 and 5-to-1. Even if your broker offers 100:1 leverage, you're not obligated to use it. Using lower leverage gives your trades more room to breathe and reduces the likelihood of being stopped out by normal market fluctuations. Diversification is another strategy to mitigate risk. Don't put all your eggs in one basket. Spread your investments across different currency pairs, time frames, and asset classes. For beginners, a diversified portfolio might include 50% in major forex pairs, 25% in blue-chip cryptocurrencies like Bitcoin and Ethereum, and 25% in stablecoins or cash. This approach helps ensure that one bad trade doesn't wipe out your entire account. Choosing the right broker is also essential. Not all platforms are created equal. Look for a broker that supports your learning curve with the right tools and safeguards. For instance, crystalballmarkets.com offers transparent leverage options, built-in risk controls, low minimum deposits, and demo accounts for practice. These features can be invaluable as you develop your trading skills. Let's revisit the story of High Stakes Tom, a trader who, in 2021, live streamed a $100,000 trade on a meme coin using 50x leverage. He ignored all basic risk management strategies: no stop loss, no position sizing, and full account exposure. Within 2 minutes, the coin dropped 3%. His position was auto liquidated, and he lost everything. His mistake was overconfidence and a lack of understanding of how leverage and margin work. Don't be like Tom. Use leverage only when you have a tested strategy and proper tools in place. To wrap up, here are some essential habits to protect your investments over the long haul. Keep a trading journal to record your setups, reasoning, entries, exits, and results. Review it regularly to identify patterns and areas for improvement. Set daily risk limits. Don't lose more than 3 to 5% of your account in a day. If you hit the limit, walk away. Avoid revenge trading, losses happen, and trying to win it back by increasing size or leverage emotionally often leads to more significant losses. Finally, commit to continuous education. Stay sharp by learning from professionals, not just social media influencers. Remember, leverage isn't inherently good or bad, it's a tool. Like a knife, it can help you build, or it can hurt you. The difference lies in how you use it. If you're new to trading, take it slow. Learn to trade without leverage, build your skills, and master your risk controls. Then, if you choose to scale up, do it the right way, with structure, discipline, and humility. It's not about making money fast. It's about not losing money foolishly. Thank you for joining me on Financial Market Insights for Traders. Until next time, trade smart and stay informed.